What is up, you guys? Pete DiCarlo here, and today I want to talk about a specific position that I just opened up on NIO. We're going to talk about NIO, kind of where I see it going, but what I really want to make this video for is teaching you guys how to sell puts. Selling puts is one of the best ways to make consistent income from trading stocks and investing in stocks, and it's actually how Warren Buffett made a huge amount of his money when he first started investing. And so we're going to kind of go over NIO, where do I see it going, but we're mainly going to go over my put position that I sold and kind of give you guys a understanding on what selling puts is. It's a strategy that I really like to use when the market is volatile, like it has been for the past couple of weeks. So I'm going to explain that, and let's get started, guys. All right, so taking a look at NIO, first and foremost, you can see here, this is a weekly chart. We've already had a massive year for the stock. The stock so far in just the past year is up, let me see, close to 1,281%. And you can see right here too that we actually hit highs at one point of $66, which was 2,557%, which is insane. So instead of just buying shares or buying options here, what I have decided to do is sell puts. So let's talk about that. Everybody knows what options are and what options do. If you have no clue about options, then you can actually go on our YouTube channel, just type in Peter DiCarlo options. We have a whole playlist, and I will try to remember to link the video right here for you guys. But if you don't understand what an option is, I highly recommend you go watch that. But essentially an option is just a contract between you and a seller, but we're going to be the seller in this instance, between you and a seller, essentially saying that you think a stock will be a certain price by a certain date. Now, when you buy a contract, you are buying that from somebody else. This is something that not a lot of people actually understand, that there is a seller, there is somebody on the other side of that. Most of the time, it's usually banks. Banks write and sell a lot of options contracts. However, so a lot of just normal, retail investors and retail traders like myself like to sell options. So the best way to think about selling an option is that everything is opposite. So if you are somebody who is buying a call, you want the stock to go up. If you're selling a call, you want the stock to go down. If you are buying a put, you want the stock to go down. If you're selling a put, you want the stock to go up. And selling puts is really what I want to talk about in this video. So let's just take a look at NIO. You can see NIO has a pretty strong support right here at $38 and $35. So normally, what you could do is just buy shares. And if NIO bounces here at $35 and starts to move back up, you will make money. If NIO falls down from where it is right now, it's trading right now at about $36. If it goes down, you're going to obviously lose money. If it goes sideways, you're not going to make anything or lose anything. So that's with shares. Now, if we bought a call, because we're bullish, if we bought a call on NIO, what would happen is if the stock sat sideways until our expiration, we would lose all of our money because of something called theta decay. I explained that in the options video I referred to earlier. So if the stock just sat sideways, didn't move at all, just bounced between like $35 and $36 until our expiration, we'd lose all of our money. If the stock went down, obviously we would lose all of our money. If the stock went up, we would make money. But even if the stock went up, not to our strike and way past our strike, we would still lose all of our money. So you can see that from a risk standpoint, trading options just straight up normally is really not the best, because while you can make unlimited gains, you really can only make money if the stock goes heavily in the direction of the call or put that you have. But there is a way that you can actually make money whether the stock goes up or sideways and even down, as long as the stock closes above your strike. And this is by selling puts. So remember how I said that if you're buying a put, you want the stock to go down. Well, if I'm bullish on something like NIO and I think NIO is going to go up, what I can do is sell a put to somebody who is bearish on the stock. And now the way that you do that, and this is think or swim, so I'm going to make this a little bit bigger so you guys can get a better understanding of this. But what you can do, let me make this a little bit bigger for you guys. All right, here we go. Sorry, it's gonna, for some reason I have an ultra wide monitor and it's hard for you to see. So let's take a look here. This is an options chain and this is the put section right here. Now on Robinhood, it's going to look completely different. On something like Webull, it's probably going to look similar to this, but this is TD Ameritrade's and I highly recommend TD Ameritrade. Now when you're looking at an options chain, if you have no clue what this is, you can also go on our YouTube or just go into the search bar, type Peter DiCarlo and look up options. And you should see like an options chain section. And it's a video where I talked about breaking down this entire options chain and what all this means. But right now you can see the bid, which is what people are willing to pay for the option. You can see the ask, which is what people are willing to sell for the option. You can see the volume, which is how many of those contracts are traded today. You can see the open interest, which is how many contracts are being held currently, because people normally don't hold contracts that long. Then you can see the implied volatility, which we'll talk about in another video because I need to go in depth on implied volatility for you guys. You can see the theta decay, which is how much that option decays in a single day. We're going to talk about that. It's extremely important. And then we're going to talk about the probability of being out of the money, which is what we want. We want the stock to expire. We want the option to expire worthless. So let's look right now at NIO. So this is a $34 put. So this means that if I'm buying this straight up and I think the stock is going to go down, I'm going to buy it. Now, if I would think the stock's going to go up, what I'm going to do is go ahead and sell a put on NIO. So this is a put that I sold. Now, when I sold this put earlier, it was a lot farther out of the money, but NIO continued to fall after I had purchased, after I had sold this put to somebody. So all you do is right click, hit sell, go to single, and then you can go through, make sure you're selling to open, and then hit confirm and send. And I'm not going to do that because the market's closed, but that is how you would sell a put. Now, what does this mean? So by the date that you're selling, which for me is March 12th, which is this Friday. So I have 4 days till expiration. As long as the stock closes above my strike price, which in this point is $34, as long as NIO can close above $34 by this Friday, I will make the premium. The premium as of right now is the spread between these numbers. So I will make $125 per contract as long as NIO closes above my strike, which is $34. Now, in order to do this, you're going to have to put up something that's called a collateral. So what any broker that you have is going to do is they're going to take collateral from you. The collateral is the strike, which is $34 times 100, because that's, what a contract is, times 100 shares. So in order for me to put this trade on, I had to put up $3,400. And in return, I will get a premium of $120 as long as NIO closes above $34. And if you think about that, that is a 3% return, because 30, quick rounded numbers, 3,000 divided by $120, which would be my profit, is 3%. 3% in a week is pretty huge for something that's relatively safe. Now, if the stock, like I said, closes above 34, I will get the premium, and what they will do is release the collateral to me. Now, the beautiful thing about selling puts is that theta works for me. So if we take a look here at our theta decay, you can see minus 17. That means minus $17. So every day that somebody is holding this put, they are losing $17 even if the stock just sits sideways, which means, normally when you're playing options, you're just losing money and losing money and losing money. Well, where does that money go? That money goes to the seller, which is me. That money goes to me. So if I'm selling it to them every single day they're holding it, I'm banking in $20, which is amazing. And the cool thing too is you can actually close these positions early. So let's say that the max you can make on this position is $120 in a week. What you could actually do, say you're up $80 tomorrow, you can just close the position and you would buy that put back. And then guess what? The position's closed, you get all of your money back, and you made $80. So like I said, if it closes above 34, I get the premium, which is $120, and my broker gives me my money back, the $3,400 collateral. Now, let's play devil's advocate and let's look at the worst case scenario. Let's say that NIO closes at $34. Let's say it closes right below $34 at $33.50. Well, now what happens? So in this case, I would still keep the $120 premium. No matter what, I get that. Unless I close it early, I get that. So I still keep $120 premium. And on top of that, I am forced. There's no options here. You are forced. That's why the broker takes the collateral up front. You are forced to buy 100 shares of NIO at your strike. So at this point, I would end up buying 100 shares of NIO at $33.50 per share. And if I bought, 100 shares of NIO at $34, and now the price of the stock is $33.50, that means I lost 50 cents per share. At the time, 50 cents times 100 shares means I'm down $50. But wait, not really, because if you think about it, yes, I'm down $50 because I bought the shares for $34 and right now they're worth $33.50, but you have to remember at the end of the day, I made that $120 on that premium already because no matter what, I keep the premium that I got. So that means really I made $120 minus the $50 loss that I have right now, which means really net, I made $70. So you can see that you will make these premiums no matter what. Worst case scenario, you get stuck buying the shares. This is why you want to sell puts on companies that you believe in for the long term. Now, I'm going to make a video in the next couple of days talking about how Warren Buffett did this to make basically like his small fortune when he first started. But essentially, all you would do instead of trading these like I do, and I'll talk about that more, instead of trading them and getting them for 1 week out, what you would do is just set basically limit prices. So like if you look at something like, say Apple, Apple's trading at $115, what you could do is just sell puts at $100. And every single week that Apple closes above $100, you end up making $11. But if you had $100,000, you'd make like $1,100 every single week. And then the one time per year or the one time per 5 years that the stock actually dumps, like we're seeing, it's down 15%. If it actually falls to $100, you get to buy it and keep the premium. So I'm going to do an entire video talking about that. I'm also do an entire video talking about rolling out your options. So guys, in general, I hope that you guys enjoyed this video. I hope that this gives you a better understanding on selling puts. And as far as NIO is considered, I think that we should get a bounce here at $34. If it closes below $34, I will be forced to buy the shares, but I think that even if it closes below 34, we should bounce and hold $30. So I'm not going to be that worried because I still think I'll be getting a really good price for this company. And that's the point of selling puts. If you guys want to be a part of my private academy, get access to all my trades live as soon as I take them, live stream with me and my team every single morning for the first hour of market open, get access to our 60-hour course library where we talk about these things all the time. And I'm literally, that entire course system is set to take somebody from an absolute beginner all the way up to my skill level. I've been trading full time for the past 7 years. Use the link down below, use the code Academy90 and start for $10 your first month. Thank you guys for all of the support and I'll see you next time.